So yeah, we actually got a question last Wednesday in our Canadian income stock chat with clients, and the individual asked, as interest rates continue to fall, what impact will this have on bank earnings? And essentially, just considering the 25 basis point decrease in the Bank of Canada's policy interest rate to 4.5% last week. I thought that it would be a good topic to cover on the podcast, and it is a question we get quite a bit. But first, I must say, effects of interest rate changes on bank profits do vary significantly by institution and time. So just keep this in mind that I am just going to be going over some general themes and make a bit of a conclusion at the end. So, looking at when interest rates rise, generally, this increases profitability across the banking sector due to rising interest rates will increase a bank's net interest margin as they take advantage of the greater spread between the interest they pay to their customers and the profits that they earn by investing, as the bank's cost of doing business are generally less affected. As well, higher interest rates are normally a sign of a booming economy, meaning demand for loans to businesses and consumers should be high. But it is somewhat of a double edged sword, as if rates go too high, this could discourage borrowers, decreasing growth, and lead to larger credit losses, which can impact profitability. And I placed in an example of TD Bank's net interest margin over the past 11 quarters. If you're watching on YouTube, you can see this up on the screen. And the Bank of Canada began increasing its policy rate in March of 2022, and as such, we saw TD's net interest margin expand from about 1.57% as at January 31st of 2022 to about 1.82% by January 31st of 2023, when rates were then around 4.25%. So you can see the increase there that the bank had experienced. Now, when interest rates decline, generally this decreases profitability across the banking sector, as the US Fed and Bank of Canada lower interest rates. They encourage consumers to borrow more money to spur the economy, which is good for growth. But declining interest rates will decrease a bank's net interest margin as they earn less on short term loans, meaning the spread between loans and the interest they pay customers shrinks. As well, lower cost of funding can lead to increased competition for deposits among customers looking for greater returns from their cash holdings. And as you can see here up on the screen, this is a direct quote from TD's Q2 2024 conference call, where they say, as we look forward to Q3 of 2024, while many factors can impact margins, we expect lower net interest margin from downward pressure due to competitive market dynamics. Now, another thing to keep an eye on is that the yield curve has been inverted for quite some time, meaning that interest earned on short term bonds is higher than long term bonds. And as an example, we actually have a bank under coverage that isn't a typical bank like the big banks in Canada, but it's currently experiencing some net interest margin pressure given the inverted yield curve, as its loans are longer term at lower rates than compared to its deposits, which are shorter term at higher rates. But as the yield curve normalizes, we should also see net interest margin have somewhat of a benefit there. Now, to conclude, overall, results indicate that changes in interest rates have a strong influence on banking profitability, but their precise impact is quite complex. Just looking back at TD's quote in their Q2 2024 results, indicating that many factors can impact margins. So, there's many things at play here. Generally, though, rising interest rates will, in theory, increase net interest margin, but elevated rates can lead to less growth and lead to larger credit losses, which offsets those gains. Now, when we're dealing with falling interest rates, this, in theory, will decline net interest margin, but may encourage more borrowing, propelling growth, and lead to lower credit losses. And lower cost of funding may also lead to more competition for high interest deposits, which will also decline a bank's net interest margin. Now, looking at how a specific bank will be impacted really comes down to analyzing their operations, including its loan portfolio, deposits, and how they are invested into capital markets, as lower interest rates may decrease their net interest margin, but these lower rates are generally positive for banks' capital markets division or wealth management. So the bottom line, though, is that studies really demonstrate that lower interest rates result in lower net interest margins. However, their negative effects are offset by increased fee revenue and decreased loss provisions. So, really, how much that offset is really depends on the institution itself. So, it's quite dynamic, the things at play here. But these are just some general things that you can kind of take away when looking. Usually, if we do see an interest rate increase, usually banks will lead based on that, just their stocks, bank stocks. But yeah, that's my piece, and maybe the guys have some questions or critiques.
It was a good overview. As you said, though, it's a very complicated
Hmm.
it's a very complicated thing to really address. And one of the things that complicates it more is in the Canadian banking sector, in particularly, all the big banks have really expanded outside of their core banking
Yep.
business. So we think of banks, they take deposits, they make loans, that's their core business. But now insurance, wealth management, capital markets are also significant contributors to earnings as well. They have different sensitivities, so it's not. I mean, it's not a simple question to answer, but I think you did a
Yeah.
good job of answering for core banking, certainly.
Yeah. Thank you.